You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. I'm Susie, and I'm here with Miro.
Hey, everyone.
It is February 9th, 2025, and today we are looking at the Q4 2025 results for Apollo Global Management. And just a quick reminder before we start, we're just two friends chatting. This isn't financial advice, just personal opinions, so please do your own homework.
Or at least read the footnotes.
Exactly. Okay, Miro, looking at the headlines here, it looks like a bit of a disaster. I see net income down 61% quarter over quarter. That feels violent.
It's noise, Susie. It's pure noise. Look, if you're trading off the GAAP net income number for an alternative asset manager, you're looking at the wrong map. Yes, GAAP net income crashed to $660 million, down from $1.7 billion last quarter. That looks terrible. But the actual business, the cash-generating engine, it was a record quarter.
So wait, so the headline number says crash, but the business says record? Help me bridge that gap.
It's insurance accounting. Apollo owns Athene, which is an insurance giant. In GAAP land, they have to mark to market their future liabilities. This quarter, the expense for future policy benefits jumped by over $2 billion. It's basically an actuarial adjustment, a math change, not a cash leak. If you look at adjusted net income, ANI, which is what actual investors care about, it was up 13% to $1.54 billion. That's $2.47 a share, a record high.
So basically, the accountants decided they owed more on paper, wiped out the statutory profit, but the cash register kept ringing louder than ever?
Pretty much. Fee-related earnings hit $690 million. Margins are sitting at 55%. It's a machine.
Okay, so did the market buy that? Because usually, even when it's just noise, an algorithm somewhere sees negative 60% and hits the sell button.
It was messy. The stock spiked right at the open, hit almost 140. I think people saw the beat on the adjusted number, but then it just faded. Sold off all day to close flat, actually down a tiny fraction at 133.95. I think people are still digesting the complexity, or maybe just selling the news after the run-up we had in December.
Yeah, that makes sense. It feels like a good but complicated quarter. Mm-hmm. But you know what stood out to me? It wasn't the numbers. It was the attitude. The CEO, Marc Rowan, was basically taking a victory lap on, what did he call it? Zero software exposure?
Yeah, that was a flex. Well, every other private credit shop has been piling into software debt. Apollo's out here saying, we have zero exposure in private equity and rounds to zero in insurance.
It's wildly counterintuitive, right? Usually tech is where the growth is, but he sounded like he was looking at a train wreck happening in slow motion and was just glad to be standing on the other platform.
It's the anti-bubble trade. They're playing offense while everyone else is wondering if their software valuations are real. I mean, they originated $300 billion of volume in the last year. $300 billion. They aren't just buying assets anymore, Susie. They're manufacturing them.
That scale is actually hard to wrap my head around. But let's stick a pin in the manufacturing point, because I want to understand how they are doing that without taking on the risky stuff everyone else is buying. All right, let's get into the details.
Well, the short answer is they stopped acting like asset managers and started acting like a factory.
A factory. That's not very Wall Street.
No, but it's brilliant plumbing. See, most firms just go to the market and buy bonds that a bank issued. You're fighting for scraps, you're paying fees, and the yields are fine. Apollo said, forget that. They went out and bought the actual platforms that write the loans. They own the company that lends to Delta Airlines for engines. They own the company that finances inventory for retailers.
So they cut out the middleman.
They became the middleman. They call it origination platforms. And because they own the pipe, they aren't hoping there's good stuff to buy. They just turn the faucet on. That 300 billion number isn't just volume. It's effectively proprietary product. They're manufacturing their own yield.
Which explains the confidence. If you make your own assets, you don't have to chase the latest hype cycle just to deploy cash. Which, I guess that brings us back to that software comment.
Right.
Because usually when a CEO says, we have zero exposure to the hottest sector on earth, they're apologizing. Marc Rowan sounded like he was bragging.
It was a total flex. He literally said, in our PE business, our software exposure rounds to zero. And look, he's making a massive bet on dispersion. Basically, while everyone else was piling into software debt at insane valuations, Apollo sat on its hands.
Which feels risky, no? If tech keeps ripping, they look like dinosaurs.
Maybe, but his argument is that everyone else was playing agent, just buying what was hot so they could sell it to the next guy. He called it out specifically on the call. He said, if you were aggressive at a point in time when valuations were very high, you're playing defense now. I assure you, we are on offense.
I assure you, that's ominously polite. So basically, he thinks the tech trade is about to break, and he's standing there with the butterfly net to catch the pieces.
Basically. And look, the guy does not sugarcoat it. He literally said, quote, better to be riding in dispersed economies where odds are high that times will be more difficult and people will need money. It suits us very well.
Perfect. A very cozy and capitalistic apocalypse.
Exactly. Distressed debt, rescue financing. When the valuations crack, Apollo is the only one with cash and zero exposure to the fallout. It's classic contrarianism, but on a massive scale.
Okay, but Miro, you're sounding a little too impressed. Should I check if you're on their payroll? Where's the catch? There's always a catch.
There is a catch, and it's right in the weeds of page 16. The spread.
The spread?
The net investment spread, basically the profit margin on all that insurance money they manage. It compressed. It dropped 4 basis points quarter over quarter down to 1.2%.
4 basis points, Miro? That's 0.04%. Are we really worrying about that?
When you are levered 20 to 1 on a $300 billion portfolio, yes, absolutely. 4 basis points is the difference between a record quarter and a miss. They blamed it on asset prepayments. Basically, interest rates dropped a bit, so borrowers paid back loans early, and Apollo had to reinvest that cash at lower rates.
Right, the reinvestment risk.
Exactly, and this is the danger of the factory model, Susie. It's a volume game. Because their margins are getting thinner, they have to keep originating that $300 billion a year just to keep earnings growing. They're on a treadmill that's slowly speeding up.
So they're running faster just to stand still?
Not standing still, but they can't coast. If that origination machine jams, even for a quarter, the math gets ugly very fast.
High offense, high maintenance. So where does that leave them heading into 2026? Are they actually masterminds or just really good at financing?
I'd say they're masterminds of timing, Susie. That's the read on the outlook. They've basically built a fortress while everyone else was out partying in the software bubble. So, to your question, they aren't just financiers, they're disciplined contrarians. They're betting that the everything rally runs out of steam, and when it does, they're the only ones with the dry powder to clean up.
Which feels incredibly adult. Like they're the designated driver of the financial crisis. But what if the crash never comes? What if tech keeps ripping and the soft landing is real? They risk looking like they've missed the biggest party of the decade, don't they?
That is the risk. It's opportunity cost. If valuations stay high, their zero software badge of honor just looks like a missed yield. But look at their 2026 guidance. They're projecting 20% growth in fee-related earnings. You don't forecast that kind of jump if you think you're missing out. They're pivoting.
Pivoting where? If they've tapped out the institutions, who's left to lend to?
You. Short pause. Me. The retail market. That's the sleeping giant here. They launched this ETF, PRIV, with State Street. They're basically coming for the $40 trillion investment grade market. They want to replace the boring bonds in your 401k with their private credit.
That's wild. So the outlook isn't just buy distressed companies. It's become the new bond market for grandmas.
Exactly. Democratizing the yield. It's ambitious and, frankly, it blurs the line between public and private in a way that regulators might eventually squint at. But right now, it's a blue ocean.
So bottom line for the next quarter, we're watching to see if that origination machine keeps humming without choking on lower spreads, and if they actually deploy that cash pile.
Yeah, watch the deployment. Marc Rowan says they're on offense. Let's see if they actually take the shot.
Well, offensive or defensive, at least they're making insurance accounting interesting, which is a miracle in itself.
I wouldn't go that far, but it's profitable boredom.
I'll take profitable boredom over exciting losses any day. All right, I think that covers the waterfront for Apollo. Fascinating quarter, weird headline numbers, but a massive engine underneath.
Yep. Just check the footnotes. Always.
And that's a wrap for Apollo. Before we sign off today, I want to take a quick step back and pull aside the curtain for a moment. Earnings Unscripted is an experiment by a small team of enthusiasts who are exploring the frontier of AI and how it can be used to enrich us. To be completely transparent, this episode was created by a team of AI agents, from the research analyst crunching the numbers and the scriptwriter structuring the narrative, to the fact-checking QA specialist, and finally to us, the hosts you're hearing right now. We are all working together to try and deliver high-quality, up-to-date information that would essentially be impossible to produce this quickly otherwise. We're really trying to push the boundaries of how machines and humans can tell stories together. So if you have questions, comments, or just want to tell us what we missed, reach out at earningsunscripted@datamadness.ca or follow the project on X.
I'm already downloading the next 10K. See you after the next call.